guys, welcome to the Introduction to Finance and Accounting course by Simplilearn. So ever wondered why some people seem to always have their money under control while others are constantly stressed about it? Or how businesses manage to make smart moves while still paying employees, renting offices and turning a profit? Well, the secret behind all of this is one powerful thing, and that is finance. So today we are going to deep dive into the basics of finance and financial management in the simplest way possible. Are you ready? So let's go. We'll start this with understanding what is finance. A big question. In the simplest terms, finance is all about managing money. That's it. It includes everything to do with how we earn, spend, save, invest, and even borrow money. Whether you are handling your monthly salary, running a business, or managing the economy of the entire country, finance is a toolkit that helps you make the smart money decisions. So the question arises, where do we use finance? So finance is not just for bankers, investors, or the Wall Street types. It's literally everywhere around us. At home, when you decide how much to spend on groceries or how much to save for a vacation, that is also finance. At work, when your company decides how much to spend on marketing campaigns or whether to hire new employees, that's also finance. So even governments use finance to plan budgets for building roads, schools, defense, and the public welfare programs. So if money is involved, finance is involved too. So why does finance matter? Here's the real deal. Money is limited, but our needs are unlimited. That's exactly why finance matters. It helps us to spend wisely instead of randomly or impulsively, helping us to save for emergencies or big goals like buying a house or starting a business. That is also there to invest so our money grows over time instead of just sitting idle. And then we will avoid the debt traps that can lead to serious financial stress. In short, finance is always equal to better control over your future. So let us understand with the help of a real life example, so managing salary versus running a company. So let me break it down with a simple example. So imagine you just landed your first job. Congratulations, you earn 50,000 a month. You pay rent, buy groceries and pay your Netflix bill and try to save a little at the end of the month. That's personal finance, managing your own money. Now imagine running a company that earns 5 crore a year. You have to pay salaries to the employees, invest in the new products and keep some. Then you can even pay the taxes and keep some profit for the future growth. That's corporate finance, managing the money of a business. So these principles are the same. It's all about making money decisions, but the scale and the complexity are very different. So then we have, what is financial management? Now let's take a step further. While finance is about knowing that money exists and what it's for, financial management is about the organized, smart way of handling finance, especially in business. So it involves planning how money should be used, organizing financial activities, directing funds where they are needed the most, and controlling the expenses and investments. So think of it like finance is knowing you have money and financial management is knowing exactly what to do with it. So let us understand, why do businesses need the financial management? So because without it, businesses would be running blind. With proper financial management, a business can budget effectively, so money is not wasted. It can invest in the right places, that is choosing projects that bring the best returns. Then we have keep costs under control, making sure expenses don't spiral out of control. Then we have increased the profits, that is by managing money smarter, not just harder. So then we have survive and grow, that is navigating the challenges and planning for the future. You can think of financial management as the GPS system of a company's money, helping the business know where it is, where it wants to go, and the best route to get there. So who handles the financial management? So in most companies, financial management is the job of a financial manager. Then it can be the job of a chief financial officer, that is a CFO, or a whole team of accountants, analysts, and planners, depending on how big the business is. They make sure your salaries are paid on time, cash flow stays healthy, so bills are paid without delay. Then budgets are followed strictly and money is used smartly to support the business goals. So, what are the goals of financial management? So, here's a quick rundown. So, maximize the profits but ethically and sustainably. And then we have ensured there's always enough cash to run daily operations smoothly. And then we can help the businesses grow safely without taking unnecessary risks. And then can use resources wisely, no waste or careless spending. Then we can increase the company's value over time for shareholders and stakeholders. We can keep the investors and the partners happy with transparent and smart financial decisions. Then we can minimize the financial risk to protect the company from unexpected problems. So basically, it's about being smart, stable, and strategic with money. So the real life examples of financial management. So let's have a look of the real world decisions that financial management supports. So if a company wants to launch a new product, financial managers help by setting up a budget for the launch, then estimating how much revenue the product could generate, and then finally deciding on the pricing strategy. And then it can even plan how much to spend on marketing. So these kinds of money decisions happen every day and are crucial for keeping a company strong. So let us understand, what does a financial manager actually do? So think of a financial manager as the money strategist of a business. Here's what they typically do. So they analyze the financial data to understand how the company is performing. They create budgets and financial reports to guide decision making. Then they help the company make investment decisions, where to put the money for the best returns. Then they forecast the future profits, risk, and cash flow to plan ahead. And then they can even monitor the expenses and income to keep the business on track, and then finally suggest ways to save money or grow profits. So they are not just number crunches, they are the decision makers. Think of them as the people who make sure the company never runs out of money, even while trying to grow fast. So finance and financial management may sound like big, complicated words, but at their core, they're about something very simple: making smart money decisions to build a secure, successful future, whether for yourself or a business. So next time you hear about finance, remember it's a secret sauce behind every smart spender, every successful business, and every thriving economy. And now you exactly know what it means and why it matters. So let's now move into the next chapter. So welcome to this next chapter. So you might have heard about the word accounting thrown around in business news, or maybe you have seen it in the job description as well. But what it is in really, and why should you care? So let's break it down in this chapter in a way that's super simple, even if you have never taken a finance class before. So let us understand, what is accounting. So at its core, accounting is the language of business. So just like we use the words to communicate with each other, businesses use accounting to communicate their financial health. So accounting is all about recording all the money a business earns and spends. It is also about organizing that information in a clear way. Then it can analyze it to make decisions, and finally reporting it to the stakeholders like investors, government, and owners, and can understand what's happening. So think of it as your business diary. So it tracks every penny that comes in and goes out. So let's now understand the double entry system, that is basically a debit and a credit. So now here comes the cool part, double entry counting. This is one of the most important ideas in accounting. So the basic rule is every transaction affects the two accounts. So imagine you are buying a phone for your business. So your cash decreases on one account, but your equipment increases in another account. So one account is debited and the other is credited. But wait, what's a debit and a credit? So let's have a basic knowledge on that. So in case of debit, think of it as adding value to the assets or expenses. And in terms of credit, think of it as reducing value from assets or adding to the income or the liabilities. So then, there we have a quick cheat sheet for the debit and the credit. So let's move on to and see that. So on the left hand side, you can see basically the type of account, and in between it is increased by, and on the right hand side it is decreased by. So in case of assets, your increase by is debit and your credit decreases. And in liabilities, the increase by is the credit and the decrease by is debit. So similarly for income, your increase by is credit and decrease by is debit. And in expenses, increase by is debit and decrease is credit. So in terms of equity, your increase by is credit and your decrease by is debit. For example, let's say your business sells a product of 1,000 in cash. So your debit is cash 1,000, you received cash. But then your credit is the sales of 1,000, you made income. So that's double entry in action. So let's now move on to understand the key financial statements. So now that you are recording things, what do you do with all those informations? You turn it into a financial statement. So these are the superhero tools of the accounting world. So the first one is income statement. This is basically a profit and a loss statement. So it basically shows how much profit or loss the business made over a period of time. And the formula for this is revenue minus your expenses is equal to profit or its loss. For example, if you earned 10,000 and spent 7,000, so your profit is 10,000 minus 7,000, that is 3,000. So the answer is the business making money? So ask to yourself. So let's now move on to the second term, that is balance sheet. So it basically shows what the business owes and the owner's equity as of a particular date. So the formula for this is assets equal to liabilities plus equity. For example, so if your business has 1 lakh in assets and 70,000 in liabilities, so then your equity is 30,000. What it answers is what's the financial position of your business right now. So you can actually get the answer from this. So let's now move on to the next one. We have the cash flow statement. So it basically tracks the actual flow of cash in and out of the business. So it is broken down into operating activities, that is for the cash from daily business. Then we have investing activities. This is basically the buying or the selling of the assets. Then we have financing activities, that is the loans, investor money, etc. It basically answers, do we have enough cash to keep running? So sometimes businesses look profitable on paper, that is the income statement, but still struggle because cash is not flowing well. That's why this statement is crucial. So let's now move on to the basic accounting principles. So now that we know the tools, let's go over the rules, the basic principles that guide how everything works. So the first principle we would be talking today is accrual principle. So this basically record the income and the expenses when they happen, not when the cash is received or paid. So before only it is paid or received, you can actually record the income. For example, you sell a product today but receive payment next week. You can still record the income today by using the accrual principle. So then we'll move on to the next one, that is consistency principle. So it is basically sticking to one accounting method year after year. So this helps with comparing the performance over time. So then we'll move on to the next one we have, going concern principle. So through this, we can basically assume the business will keep running for the foreseeable future. You don't record assets like you are going to shut down tomorrow. So then we'll move on to the next one we have is matching principle. So it basically matches the expenses to the revenue they helped generate. For example, if you earn 50,000 in December and spend 10,000 on ads that helped make that sale, record both in December. The next one is conservatism principle. So it basically about being cautious and don't overstate income or assets. So if you are unsure, basically go with that option that shows less profit. So then moving on to the next one, we have the cost principle. So record assets at their original cost, not what they are worth now. For example, you bought land for 5 lakh. So even if it's worth 10 lakh today, you still show 5 lakhs in the books. So this is all about the basic accounting principles. So after you have a basic understanding of accounting, let's move on to the next chapter, getting deep dive into the valuation techniques, that is the discounting and the compounding. So let's move on. So here again, now that you have got a basic understanding of accounting and financial statement, it's time to explore something even more interesting. So how we value money across time. Sounds fancy, right? But don't worry, we are going to break it down in the most simple and relatable way possible. So let us now understand why this even matter. So imagine someone offering you 1,000 today or 1,000 next year. So which would you choose? So your answer would be take the money today. Why? Because of something called the time value of money. So that is a key concept in finance. The time value of money, that is the TVM, it means money today is worth more than the same amount in the future. And to calculate how much future money is worth today or how much today's money will grow in the future, we use two important techniques. There is a discounting, there is a future present, and compounding, that is the present future. So let's break both down with definitions, formulas, and the real world examples. So let's understand with what is discounting cash flow. So under discounting cash flow, let us first understand what is discounting. So discounting is the process of finding out how much a future amount of money is worth today. So think of it like if someone promises to give you 10,000 5 years from now. How much is that really worth today? So that depends on something called the discount rate. So usually based on inflation, interest rates, or the return you expect from investing, that is basically an investment return. So let us now understand this with the help of a formula. So the formula over here is PV is equal to FV divided by 1 plus R to the power of N. So calm down guys, I will be actually explaining it to you so that it gets simple. So here PV is the present value and FV is the future value, that is how much you will get later, and R is the discount rate. For example, as a decimal we count it like 0.0848%. And then we have N is equal to number of periods, it is like years. Then we'll understand this with the help of a real life example. So understanding the present value. For example, you expect to receive 20,000 3 years from now. So the discount rate, that is the interest rate, is 10% per year. So here we will have a step-by-step calculation. So we will use this formula, that is present value, that is PV is equal to FV divided by 1 plus R to the power of N. So where FV is obviously 20,000, R is 10%, that is 0.1, and N is 3 years. So basically PV is equal to 20,000 divided by 1 plus 0.10 because it is 10%, and to the power of 3, that is for the 3 years. And it will approximately come around 15,030 rupees. So 20,000 to be received 3 years from now is worth about 15,030 today. So if the discount rate is only 10% per year. So I hope you understood the discounting cash flow. So let's now move on to see the compounding cash flow. So let us now understand what is compounding. So compounding is the reverse of discounting. So here we calculate how much today's money will grow in the future if it earns interest. Think of it like planting a seed and watching it grow over time. So let's now understand with the formula. The formula is FV is equal to PV into 1 plus R to the power of N. So here PV is the present value, that is today's amount, and R is the interest rate or the growth rate. FV is obviously the future value, that how much you will get later, and then N is the number of periods like the years. So let's now understand this with the help of an example. So let's say you invest 10,000 at 8% annual interest for 5 years. So we will use the formula of the future value formula, that is FV is equal to PV into 1 plus R to the power of N. So where PV is basically the present value, FV is a future value, how much you will get later, then R is a discount rate as a decimal like the 0.08 for 8%, and N is number of periods, it is the like years. So now if you plug in the values, PV is 10,000 into 1 plus R. R is 8%, that is 0.08 to the power of N, and N is for 5 years to the power of 5. So if you now calculate, it will come approximately around 14,690. So this is the best time you can actually pause the video and calculate by your own to actually match with my result. And then that's compounding in action. Your money makes money, and then that money makes more money even. So that's all about discounting and compounding. So let us now understand the applications of discounting and compounding. So you might be wondering, cool maths, but where do I actually use this in real life or business? I would say that is a great question. These concepts are everywhere in finance and investing. So in discounting, we are initially valuing our business or a startup. That is, investors use discounted cash flow, that is a DCF, to estimate a company's current worth based on future profits. Then, basically, we take on the loan decisions. That is, a bank's discount future loan repayments to decide how much they can lend today. Then we have even bond pricing for under discounting. The value of a bond is the discounted sum of all the future interest payments plus the repayment. Then coming under compounding, where compounding is used, it is basically used in savings and investment planning. So if you want to retire with rupees 1 crore, you will calculate how much to invest today using compounding. Then we have compound interest. So this is what makes your savings account grow faster than simple interest. And then we have mutual funds and stock market. So it basically returns from reinvestment earnings help your investments grow year over year. So here basically we have some final thoughts to sum it up. So discounting is basically the future present, that is what's the future money worth now. And then compounding is all about present future, that is how much will money grow. So these two concepts are the backbone of finance. So once you get the hang of them, you can basically evaluate the investment options, plan your own finances smarter. Basically, it can be of your own or your own business. You can understand how business are valued. So these are the greatest skill you have acquired today, and let's now move on to the next chapter. So hey there, now that you understand the basics of accounting and have explored valuation techniques like discounting and compounding, let's put it all together. So you might be thinking, okay, accounting tracks the money and finance plans how to use the money. But how do they actually work together? Good question. In this chapter, we are going to bridge the gap between the two. So let's start with how finance and accounting interact. So think of accounting and finance as the two best friends in the business world. So accounting is the recorder, that it tracks every transaction, organizes data, and prepares the reports. And finance is the strategist. It uses that information to make decisions about budgeting, investing, forecasting, and more. So in short, accounting tells the story and finance decides the next move. So let's now understand accounting in financial decision making. That is basically, there is a use of accounting information in financial decision making. So let's imagine you are the owner of the small business. Your accountant gives you three key financial statements. First, the income statement. Second, the balance sheet. And third, the cash flow statement. Cool. But now what? So this is where the finance steps in. It looks at these numbers and helps answer the questions like, can we afford to hire new staff? Then another, should we open another branch? So then the question would be, is this a good time to take a loan? And finally, why did profits fall last quarter? So these decisions are made using accounting data as the foundation. So let's now move on to see the financial analysis using accounting data. So one of the most powerful tools in this relationship is something called as ratio analysis. So what's ratio analysis? So it's a process of taking numbers from the financial statements and turning them into easy to read indicators that tell us about the health of the business. So here are some of the most commonly used ratios explained simply. So let's now move on to see the ratios with example. The first one is profitability ratios. So how well are we making profits? That is a net profit margin. So the net profit margin is equal to net profit divided by revenue whole into 100. So let me explain. The net profit is the amount of money a company retains after deducting all, that is the expenses, taxes and costs. And then we have revenue, that is a total income generated from the sales or business activities. So this formula basically gives you the percentage of revenue that turns into the actual profit. So this is a great time to pause and solve the question, tell us what percentage of your sales is actual profit. So basically the answer would be, if it's 20%, you keep rupees 20 from every 100 rupees sold. So let's now move on to the next ratio, that is liquidity ratio. So can we pay our short-term bills? The current ratio formula. The current ratio is equal to current assets divided by current liabilities. So let me explain. Current assets are the assets that can be converted into cash within 1 year. For example, cash, accounts receivable or inventory. Then we have current liabilities. So obligations due within 1 year. For example, accounts payable, short-term loans. The current ratio measures a company's ability to pay the short-term liabilities with its short-term assets. So shows if the business has enough cash or assets to cover bills. For example, if it's 2, you have rupees 2 for every rupees 1 of debt. That's healthy. So now let's move on to the next. We have solvency ratios. So the question arises, can we survive the long term with our debts? So it's basically a debt to equity ratio. The debt to equity ratio is equal to total liabilities divided by the shareholders' equity. So in terms of explanation, total liabilities is basically all of the company's debts and obligations. So considering both the short term and the long term. Then we have shareholders' equity. So the owner's claim after all the liabilities are subtracted from the total assets. So this ratio shows how much the company is financed by debt versus the equity. So it's a measure of the financial leverage and risk. So high number might mean too much risk. So if your ratio is 3, you owe rupees 3 for every rupees 1 owned by the shareholders. So let's now move on to the next ratio. We have efficiency ratios. So how well are we using our resources? Basically, it is the inventory turnover ratio. The inventory turnover is equal to the cost of the goods sold. That is the COGS divided by the average inventory. So cost of the goods sold is the direct cost of producing the goods sold by a company. And the average inventory is the average value of inventory during a period. So average inventory is equal to beginning inventory plus ending inventory divided by 2. So this ratio measures how efficiently inventory is managed and how many times inventory is sold and replaced in a period. It basically tells how quickly inventory is being sold and replaced. Higher is equal to faster sales cycle. So let's now understand the real world examples of finance using accounting. So let's say your income statement shows that profits have fallen this quarter. So your finance team will look at the expenses, like did the cost increase? Then they will check the liquidity, that is, are we low on cash? Then they will use the ratios, that is the revenue dropping or profit margin shrinking? Or they will forecast, like will this trend continue? Then they will decide, should we cut the cost? Then they will even think about, can we increase the pricing? And finally, they even can think about, do we need more funding? So you see, accounting provides the data. Finance turns it into strategy. So there are certain takeaways from this lesson. So let's wrap it all up with some simple takeaways. Accounting is a system for recording and reporting financial activity. Then we can even think about finance uses the data to make the decisions, plan and grow the business. Then both work together. So one provides the facts and the other builds the future. Then financial analysis, especially the ratio analysis, turns the complex data into actionable insights. And then finally, no decision in business is made blindly. Accounting is always the starting point. So let's now move on to the next chapter and explore more about finance and accounting. Hey again. In this last chapter, we saw how accounting provides the data and finance uses it to make the smart decisions. So now let's talk about one financial statement that often gets overlooked, but is crucial to understanding how healthy a business really is. That is the cash flow system. Why? You can even think of why. So because profits can lie, but cash doesn't. You could be profitable on paper but still run out of money. And that's where the cash flow statement becomes your truth teller. So what is basically a cash flow statement? So the cash flow statement shows how cash, not profits, moves in and out of a business over a period of time. It answers where did the money come from and where did it go? And to keep things organized, it divides the cash movements into three categories. And the categories we will be seeing in the later half. So the first category is operating activities. So what does it mean? So cash flows from the day-to-day operations of the business. So basically this is one of the core activity of the company. Buying, selling, paying salaries and handling the inventory. So the cash inflows from operating, we have the sales revenue. Then we have receipts from the customers. And then finally we have income from the services. Then the cash outflow from operating is payments to the suppliers. Then we have employee salaries, and then we have the rent, utilities and admin expenses. So let's understand this with the help of a real life example. So a clothing store sells 5 lakh worth of items, and that is the inflow of the cash. And then it spends 3 lakh on the materials and the rent, and this is the outflow. So the net operating cash flow is 2 lakh. So this section basically tells you if your business can sustain itself. So if you are regularly negative here, you might be relying too much on the loans or the investments to stay afloat. So let's now move on to the second activity, that is investing activities. So what does it mean? So cash flows from buying or selling the long-term assets. So this is about the future, the spending or earning money from the assets that will benefit the business in the long run. So make the two columns, cash inflows from the investing, and then we have cash outflows from investing. So the first one is under cash inflows is selling equipment or property. And then we have selling the investments like the stocks or bonds. So under cash outflow, we have buying new equipment or machinery. And then we have purchasing the land or office buildings. And then finally, we have investing in other business. So let's now conclude this with the help of a real life example. So let's say your company sells an old delivery truck for 1 lakh. And this is inflow of the cash. And then buys a new machine for 3 lakh, that is the outflow. And the net investing cash flow is minus 2 lakh. So this section shows how you are investing in growth. It's totally normal to have negative investing cash flows, especially if you are expanding. So let's now move on to the third activity, that is the financing activities. So the cash flows related to funding the business through debt or equity. So this part basically tracks how you raise the capital. So in cash or how you paid back or share profits, there is the cash out. And then we have cash inflows from financing. So under cash inflows, we have borrowing money from the banks or investors. Then you have issuing shares, that is the selling ownership. And then under cash outflows from financing, we have repaying the loans. Then we have buying back company shares. And then we have paying dividends to the shareholder. So let's now understand this with a real life example. So basically, imagine you raise 10 lakhs by issuing the new shares, that is the inflow. But also repay a 4 lakh loan, that is the outflow, and then the net financing cash flow is 6 lakh. So this section basically tells you how the company is funding itself through debt or equity and how much money it's giving back. So let's now understand how it all connects, the real life application. So let's put all together with a quick scenario. So imagine a tech startup basically generates 20 lakh from the customers, that is the operating inflow. It also spends 15 lakh on the salaries and the rent, that is the operating outflow. It buys new servers for 5 lakh, that is investing outflow. And it raises the 10 lakh from investors, that is financing inflow. Then how this looks like? The cash flow, that is the operating, would be plus 5 lakh. which is the cash flow. Then investing would be in negative, that is the minus 5 lakh. And financing would be so much great, would be plus 10 lakh. So the business is making money from operations. It is investing in growth. It is raising capital for future expansion. So this gives a full picture of what's happening behind the scenes. It's not only just about profits, but actually the cash power. So in the next chapter, we'll see about accounting for investments in the debt and equity securities. So let's now move on. So welcome back guys to the last chapter. So far we have talked about how a business earns, spends and plans its money. But what happens when a business wants to grow that money by investing it? Just like individuals do. So businesses don't just sit on cash, they often invest it to earn more returns. And those investments are usually in debt securities, like the bonds, or equity securities like the stocks. So let's break it down step by step. So we have a concept of investing in the debt securities. So what are debt securities? So debt securities are investments in the bonds, debentures or other fixed income instruments issued by the governments, corporations or financial institutions. So when a company buys a debt security, it's basically lending money to the issuer in exchange for the interest income and repayment at the maturity. So think of it like a business acting as the leader instead of the borrower. So let's understand how are they accounted for. So accounting for debt securities depends on why the company bought them. So the first one we have is held to maturity, that is HTM. So the company plans to hold the bond until it matures. Then it is recorded at the amortized cost, that is not updated for the daily price changes. Then for example, 1 lakh bond bought held for 5 years. So let's now move on to the second one. We have trading securities. So it is bought to sell quickly for a profit. Then we have recorded at a fair market value and changes are shown in the income statement. The third one is available for sale, that is the AFS. It is not held for maturity but not actively traded either. It is also recorded at a fair value, but changes go into a special reserve in equity. So let's now understand this is the real world example of debt security. So let's say your company invests 5 lakh in the government bonds. So you receive 25,000 in interest annually and you plan to hold them until maturity. So in accounting, you would record 5 lakh as an asset that is held to the maturity investment and 25,000 as interest income each year. Simple, right? So investing in equity securities. So let us understand what are equity securities. So let us understand investing in equity securities. So what are equity securities? So equity securities represent ownership in another company. So these are the shares or the stocks you buy in other business. So if debt investing is about lending money, equity investing is like becoming a partial owner. So these investments can bring the dividends, that is, if the company shares profits, then it capital gains if the stock price rises. So how are they accounted? So again, it depends on how much control or influence the investing company has. The first one is less than 20% ownership. It is basically treated as a passive investments. It is recorded at a very fair value and dividends received are shown as income. Then we have between 20 to 50% ownership. It indicates a significant value. It uses the equity method, that is, you record a portion of the investee's profits as your own. Then you have over 50% ownership. It is treated as a control. The companies are consolidated. There is a financials are combined. So let us understand with the help of a real world example, that is the equity security. So let's say your business buys 5% of the company B's shares for 2 lakh. So you receive 10,000 in dividends this year. The market value rises to 2,20,000. So in accounting, you would record it as 10,000 as dividend income and record investment as 2,20,000. That is a fair value. So if you plan to sell soon, it is a trading security. If you are holding it long term, it may be available for sale. So let us now understand the real life application. So let's say your company is sitting on 10 crore in the surplus cash. So instead of leaving it idle, you buy bonds for safe, predictable returns, that is a debt security. You invest in the tech startups shares hoping their value grows like the equity security. Then your finance team tracks these investments in your books using the classification rules above, and then you make the informed decisions about what to sell, hold, or reinvest. So this is how businesses multiply wealth, reduce the risk, and plan for the future. So we have a conclusion for this. So in this lesson, what you have learned, let's recap everything simply. So debt securities is equal to lending money for interest like the buying bonds. Equity securities are owing shares in other businesses. Then how you account for them depends on the intent, that is a short-term trade or the long-term hold, and level of control. Investments are an important part of financial strategy, and correcting accounting helps make better decisions. So then we have real companies use a mix of debt and equity investing to grow their money and maximize returns. So congratulations guys on completing your journey into the Introduction to Finance and Accounting course by Simplilearn. You have taken a big step towards mastering the fundamentals of how money moves both in personal life and business world. From understanding what finance and accounting truly mean to learn how they impact daily decisions and long-term strategies, you have built a solid foundation. You have explored essential topics like financial system, financial management, accounting principles, real-life applications, and vital role of financial professionals in any organization. You have also seen how emerging technologies are reshaping the way we track, analyze, and report the financial information. Now it's your turn to apply what you have learned, analyze the real-world cases, manage budgets, real financial statements, and make informed decisions with confidence. Thank you for being a part of this learning experience. Stay curious, keep practicing, and let your finance and accounting skills lead you to the new opportunities and success. Here's to a future filled with the smart financial choices and exciting possibilities. Thank you, guys.
Staying ahead in your career requires continuous learning and upskilling. Whether you're a student aiming to learn today's top skills or a working professional looking to advance your career, we've got you covered. Explore our impressive catalog of certification programs in cutting-edge domains, including data science, cloud computing, cybersecurity, AI, machine learning, or digital marketing. Designed in collaboration with leading universities and top corporations, and delivered by industry experts, choose any of our programs and set yourself on the path to career success. Click the link in the description to know more.
Hi there, if you like this video, subscribe to the Simplilearn YouTube channel and click here to watch similar videos. To nerd up and get certified, click here.